Okay, can everyone see our presentation? Is everything okay? Hello guys, thank you for joining us again. Thanks for the presentation. I'm Lucca Bueno. I'm here with Luis KESSE and Silvana TRIANA. We're the discussants for today's joint seminar. So just to give a quick overview of what we're going to do. So we're going to do very like a bullet through of essentially summarizing the documents that we received. We're essentially also summarizing the cornerstones of the SIU package or strategy. Then we're going to go through our extensions, and then we're going to go through our questions and references. So going very quick through already, I don't want to be redundant on the presentation from Mr. Panadori, but essentially is to increase convergence power. So ESMA is going to have their convergence is not only going to be suggestive, it's also going to be more binding, or suggestion of being more binding. Increase supervision efficiency. So as Mr. Panadori already mentioned, the idea is to make firms under direct supervision of ESMA more numerous and also more efficient and simplified and unified. Crypto regulation, like already mentioned, after the chaos that was MiCA, ESMA kind of came to the rescue, and now it's coming here to stay, especially to have direct regulatory oversight, and also to increase governance speed, especially to do an overhaul of the boarding of management, because this idea of consensus-based decision-making was too strong for digital speed markets. So the idea of this overall to oversight systemic risk. So now I give it to Luis.
So I want first to go into the common market narrative. That's mostly the baseline of European integration, and to explain to you a bit the idea behind it, or why are we talking about it, especially from a non-European perspective. This might look like a very weird approach, at least as we discussed it. The idea of European integration is the goal of having a common market where competitiveness is achieved by consolidation within the integration process. To make this more appealing to an economist, I brought a new Keynesian model that describes this process very good, in my opinion. Even though it's maybe new Keynesian, you might not like it, but Baldwin and Whiteblash described like this. The baseline pricing equation to this is also a markup pricing equation that mathematically is the same as Kaleckin one. So we have a markup, and we have a number of firms, and we have total sales here with the demand curve, and here we have the sales in relation to the actual price the product is sold for in euros. So the idea would be that this is the competition that from which the markup and the number of the markup depends on the number of firms, so the competition in the market. And if we have new firms coming in due to integration, because a new market joins the common market, we have higher competition, and we go to point 1 and then end up in point E2 prime, which is at a lower markup with lower prices, and in the end we realize higher sales at lower prices. So this is the idea behind it. And this whole SIU package now has the goal to extend this common market narrative, which happens in the real economy, by supplying cross-border market-based finance into the markets. This is mainly based on infrastructure through CSDs and CCPs that are now in one common market and not only on the country level, as you also explained. And we also shift from the market operators to a new form of PMOs that are pan-European market operators. And also the EU regulated investment funds will act more across the whole common market and not only within one country. So this is the baseline idea of it. However, this is largely challenged especially by regulationists, and they say that the European system is mostly shaped by heterogeneity and asymmetry between nations, and we can't really talk about a common market that is a level playing field, because the state of development and the modes of development highly differ. Especially to do industrial development, you need the backbone of healthy modes of productions that you can build on according to theory walls. So here's a principal component analysis of the European industrial sectors, and you see that we have like some very highly developed countries over here like France, Belgium, the Netherlands and the Scandinavian ones, and some like midfield of Italy, Austria and so on, and Germany of course, of like heavy manufacturers. And then we have like somewhat more externally exposed Eastern Europe, less developed Eastern Europe, that you can't really count into the same category as the rest of Central and Western Europe. Also, something that's always very much mentioned is the market capitalization that is tried to be enlarged by the SIU package. In Europe, it was in 2024 at 79.3% according to Eurostat data. This is much smaller than the US and not as small and more close to the UK. Then we have incredible outliers like Luxembourg, who has over 2,000% of market capitalization in relation to GDP. And we see like the black line is the European average, that this highly differs. And if we go to higher levels, the volatilities are also much higher. ESMA, for reference, was funded here. So kind of when the Euro crisis started to tone down slowly. And what is also important to say is that we had historically different modes of development, and one of the most important things to remember, I think, is how good the Hausbank model of Germany worked. The third largest economy of the world has not been built on market capitalization, but on banks working as normal banks, as we, for example, had in the presentation by Sissoko we had in the beginning of the semester. So here we go over to a geographical representation of the capital markets. We see again like the Eastern Europe countries are much less capitalized, and there's a large difference to the more developed and Scandinavian countries. And if we now join these all into one common market, there might be large dangers of that the highly capitalized ones start to go heavily into the Eastern European countries, which will lead to profit outflows, slowdowns of accumulation, and also higher volatilities that come from the West that endanger the East, which are already at a lower development stage. And building on all these dangers of financialization, I want to give over to Lucca to go more into this.
Hello again, guys. So thank you, Luis. Just continuing. Again, like as being a Latin American neo-developmentalist, I was reading the documents that were given for us, and some bells were ringing for me, especially this idea of controversies between de-risking and systemic risk, right? So essentially, the package proposing as increase of capitalization and somehow creating this nexus of European financial markets being small and fragmented as somewhat of opposite idea of gains of efficiency and potential economies of scale. Also this idea that if you simplify and unify financial oversight, it will de-risk investments, and it will allow investors to do more cross-border finance and unlock deeper pools of liquidity within the market, right? And being the structuralist that I am, I was like, okay, this sounds a little bit controversial because, well, we have increase in capitalization, which also means financialization, and also increase in capital liberalization or capital movements within all 27 European countries, right? So, oh, what? Oh, sorry guys, what? What happened? Okay, I don't know what happened. So, bringing back our toolkit of heterodox economists, we know that this micro-macro nexus exists. So, when we try to do things that are de-risking for the micro level, we might be making the whole system more fragile. I won't have time to talk about all the paradoxes, but essentially the idea is that even though it would make sense. Visible financial instability, like for example firms defaulting, is easily seen. However, it's like an iceberg. We have a lot of micro things that might weaken the whole system, and that's why the package could be happening. I'm going to go back to this. And again, if we're talking about capital liberalization and easing of capital movements, it reminds us a lot of the last decade of 1980s, 1990s, especially for major B people, this might be familiar, because we have a lot of extensive literature. This paper, for example, from 2006 from the IMF, essentially trying to find compelling evidence against financial integration and long-term growth, and essentially we can't find them. Also, there's a strong correlation between capital mobility and financial crisis with permanent losses of output, so this could also be a threat to European productive markets or real markets. Again, we have this notion of the liberalization as being having complicated effects on distribution, and as Lavoie said, especially after 2008, how easier flowing financial movements really allow for more speculative activity and herd behavior. And in the words of essentially one of the founding fathers of financialization literature, we are introducing a whole new set of risks without any real proven benefits. And so bringing back to my idea of an iceberg, we have, again, I'm not really criticizing ESMA or the package in itself. I'm just saying this is a thread that could be dangerous because, like we said, we have an overhaul of the management of the advisory board. So they would be faster to react towards systemic crisis. However, market capitalization, riskier finance is also an accelerator of those risks. So essentially, you can steer faster, but also you're moving a lot faster, right? So essentially, here's a summary of everything that I said. If we allow for more, I don't know if you can read it, it's kind of small. Sorry. Yeah. But yeah, it's essentially like contagion through capitalization, so stronger financialization, as we said. The standardization of financial regulations and also the idea to make them simpler might allow for riskier finance in heterogeneous markets. This self-claimed idea of de-risking falls straight into the idea of illusion of liquidity, or on the liquidity paradox by Minsky. And again, we found this entire idea that it's not that the package will make the system more risky, is that it has the thread to make crisis a lot faster and more abrupt. Now I pass to Silvana.
Now, for the final part of our discussion, we wanted to introduce a social perspective that we felt it was missing in the proposal. We know that the proposal of the ESMA is not exactly to be a social reform, and hence is, of course, not related to change the social security systems. However, reforms that expand the role of capital markets can have unintended social consequences, especially when savings, pensions, and public funds have become increasingly mediated by financial markets. So we can see in the SIU proposal that it creates conditions that are fertile ground for this process, especially through three main channels. The first one is the expansion of capital markets as the normal allocation systems, by promoting capital market as the main channel for long-term savings, the preferred vehicle for pensions and household wealth, and the central pillar of economic growth. The EU implicitly is presenting market as the default mechanism for allocating resources and is redefining the role of markets in social production. So activities that traditionally were mediated through effective public arrangements are now doing through markets. And this is also known in the literature as the market-based reorganization of risk and welfare, basically when markets stop being complementary tools for institutions and start being at the center of them. Our second main channel is mobilization of household savings. So the SIU emphasizes that underused household savings, especially those in bank deposits, need to be reinvested, especially in markets, as this is a big economic opportunity for them and basically necessary for economy. And also it guarantees greater retail participation in capital markets. But from a financialization perspective, this shifts households from protect savers to actually expose investors, because they are moving households from banks by savings that are pretty much more protect to market-based investments, which are very risky. And our final channel is institutional investors and pensions. Basically, capital market deepening implies a growing role of larger pension funds, more asset managers, and more financial intermediaries. And this is the main institutional mechanism through which pension systems becomes financialized, especially because social protection is then no longer based in intergenerational risk sharing, but it's just based on market logics. And this is the way that social protection becomes more tied to market performance. So even if the ESMA proposal is not entirely tied to financialized social security systems, it may be an outcome, a possible outcome that could end up happen. So more than affecting social security systems as we are just portraying, it also is affecting people's lives. So we wanted to show two main consequences that we could identify in people's lives. The first one is the weakening of democratic control and loss of voice over social protection. When social security becomes more closely linked to markets, their decision-making responds more to a market logic than to the base needs of people. And this shift just changes not only to how these systems are financialized, but also who they are accountable to. They stop being accountable to citizens, and they start being accountable to market, to investors, to the logic of financialized systems. Then citizens lost the ability to influence those social policy outcomes, and even though these policies affect their lives, they no longer have a say on them. This means that financialization reduces not only economic security, but also the citizens' voice over systems that are meant to protect them. And our second main consequence is the volatility and loss of counter-cycle capacity. Social protection is seen as a counter-cycle tool, meaning that when there is crisis in the economy, it expands its protections. It holds your back. So when systems rely more on financial markets, the resources also became more sensitive to financial conditions, meaning that interest rates, global shocks, are affecting the way you are accessing those resources, till the point that you cannot access them anymore. So the support is reduced, delayed, or eliminated when it's needed the most. This undermines the core function of social security systems that are supposed to act as a shield during economic crisis for people. So this is the last part of our discussion, and now we are going with the questions for you. My question is related to what I was saying. How can EU financial integration proceed without subordinating social protection systems to financial market logics? Now I pass the word to my colleagues.
Hello. I'm continuing my whole thing, and I just wanted to hear your feedback. So if the idea is to reduce and oversee systemic risk, but also increase capitalization of markets, aren't you just increasing contagion and financialization, so also increasing systemic risk?
Yeah, and I talked a lot about the asymmetries and heterogeneity among European states and how these might already provide an unlevel playing field when we do these integration processes, especially if they include the capital side. So my question would be, should financial supervision include more control over collusion and power asymmetries across member states to ensure a level playing field that acknowledges heterogeneity among members? Which is the challenging question for a, so to say, neutral institution in Europe, but I think this should be integrated to have an actually level playing field.
Thank you. Thank you, guys. Okay, a lot of stuff. I took also some notes. Okay, let's start with the first one. Maybe we also can touch the rest. And bear in mind, here my opinion, not the opinion of ESMA. Should financial supervision include more control over collusion and power asymmetries? Ultimately, this is we can say I can see it as the objective of the SIU, in the sense, if you have one firm that is only supervised at national level and is the champion in that country, what is and commits something illegal or not illegal, what is the incentive of the national regulator to intervene against that specific company? Usually there is not. That's the main point is that you should have someone, a referee, that is independent and there is no conflict of interest in intervening. If and that actually was the incentive to develop the SSM at banking level. The contagious at banking level was so big that at some point was better to have the banking supervision of large banks done not by the national supervisor, because otherwise I'm not going to investigate, I'm not going to find the bank that committed something in my jurisdiction, but also affecting the other countries in the EU. Too easy. At that point, it was developed the SSM, so that there was coordination at EU level, and the only national supervisor that was supervising that given bank had to share power with the EU, but also with the other jurisdictions within the EU that are affected by how the bank behaves. Similarly, you could say that it would apply also at EU level in the financial markets, because if you have the single referee, that would be in this case ESMA, can be any other EU institution, you remove the conflict of interest of the national supervisor and you intervene, trying to be a referee indeed, someone that is distant, neutral, but if there is something happening in that specific jurisdiction, you intervene. Because if you have a national supervision and there is your national champion, most probably you will do nothing. You need to remove that conflict of interest, and the referee intervenes in that moment. What else I'm missing here? I just to reduce an overseas estimate. I can see where I'm an epoch student as well. I can see where you come from the financialization. Yes, you can increase contagion. You mentioned before the capitalization. There is the famous 270% of market capitalization at US level. At the same time, my opinion is a trade-off. You either decide that you have these volatilities, but then you bounce back quicker, or once in EU, for instance, when there was the great financial crisis, in the moment we enter in the financial crisis, that was mainly bank-driven, because venture capital funds, that is, or markets like in the US, there is little compared to the US. The bounce in the US was, yes, big. They went down very quickly, but they went back also very quickly. Us, we had, I wouldn't say 10 years of stagnation, but we were driven with 10 years of very slow recovery. And maybe correlation is not causation, but we are a very bank-driven economy at EU level. We don't have the markets that they have in the US. So to answer you, it depends on, it's a trade-off. Either you decide, you take into account that you can have bounce back from burst and booms, or you take the risk to stay flat for some time, and you're not able to go back and to have something like the US. By the way, it does not mean that we advocate to have the US market or a US economy. It's a EU economy. period. On this one, I want to be very clear. Financial integration without subordination. This one, I don't know how can I can comment. My personal opinion is that you can have EU regulation, but then social protection remains at member states level. It's member states that should take over social protection and should not be given for granted. The main proposal here at the SIU level is that we are moving in a moment in which you mentioned resting your savings in the bank account. If you take into account that you have also inflation, inflation is going to erode your savings. Probably it's better to have on a side as well people that are that they do not maintain only savings on the current account, but they also invest them some way or another in capital markets, and through the investment into capital markets, then they go to small medium enterprises that are funded by funds, for instance, and then we talk about the industrialization. If you have more capitals, more liquidity, you could also redirect everything or part of it into real firms. I agree with you that maybe it's not ideal that finance go to finance and to finance remains in speculative systems, but the objective here is that that capital that is dormant in a banking account, they go to small and medium enterprises, and you develop actual firms within the EU. I would like to avoid that we go towards a system in which finance develops finance per se. The best would be that capital is directed towards firms. Other questions for you three? Please.
Would have like one
remark
addition to my question, because like when I agree with you that of course there is corruption then where maybe there's no supervision when it's just the national champion. We had these problems in Germany with the cum-ex scandal. Of course, I agree with you when we have problems where the national champion should be put more in chains because there were problems, and that the jurisdiction, the national one, might not do this. We had these problems with the cum-ex scandals in Germany also. But the problem is maybe for development, not punishing the national champion is something you have to do to remain stable. It might be contagious for other countries, but at the same time there might be some like developmental perspective on this, that you need to find other ways than just hardly punishing those ones. And from the EU perspective, an EU neutral institution of course would punish this one, but the impact will be mainly on the real economy of that member state, and we are still endangering maybe development paths or the reality of people that live in this economy.
I understand your point of having, for example, like a faster bounce back. My only, I would say, counter argument to this would be that every time we have the bounce back, we have almost irreversible distributional effects and permanent losses of output. Then, which means we're going towards a more financialized. So we would be going then towards a more U.S. style of financialized economy, right? Because we're going to lose output, or we would lose essentially also like productive capital for the sake of finance, and then we would be more of a U.S. style of market capitalization.
Again, on this, I would like to avoid to have a U.S. system. For me, it would be an EU system in which is not finance for finance, but is finance for firms and finance for people, so that capital that is again dormant in a banking account is used for small medium enterprises, firms, and then the return goes back to the saver, the investor, which can be me and you, retailers, but it's not finance for finance. It would be finance for people and for small and medium enterprises, which at this point in the EU probably is limited. At some point in 2015, there was the Capital Markets Union that tried to achieve that. They did it partially, and the Saving Investment Union is a revamp that tries to do it in a more holistic approach. On your comment, I can tend to agree with you. On the national, to me, it's my personal opinion. I would prefer to have again the referee, the neutral referee that intervenes, because the conflict of interest. There was a famous case years not long ago. It was 2021 in Germany. I knew already what I'm going to whom I'm going to refer, and was the national regulator at that point in time did not intervene. There was a scandal, and was wirecard. And ESMA had to draft a peer review on this. That I think is public on ESMA website. You can pose yourself, and we can pose ourselves the question: what would have happened if a national champion would have been supervised by a neutral authority that is contagious to other countries? Probably you would have the referee probably, I don't know, I'm not saying, I know I don't put my hand on the fire, but probably would have intervened, because there is no conflict of interest, there is not this linkage between your backyard and you do nothing, you intervene because the entity is contagion also the rest of the EU, of the continent. Mike? One?
I can.
Oh, thank you.
Yes, hi, my name is Leo from Germany. Thank you for the presentation. My question is related to the fact that the US government kind of is going insane over the last 2 weeks. And yeah, before that already. Okay. Well, my question goes to you as a regulator in ESMA. No, but I'm wondering, because from my perspective, like at the moment we see that European dependency on the US and especially on the US dollar is like becoming very, very problematic, and we can see that in the fact that right-wing politicians, for example in Germany, are already saying, yeah, okay, we are so dependent that we can't stand up to them anyway, so let's give them Greenland and let's just not take any conflict and take the US's position. And while I think that's not a very good position, and I don't like the person who said it, I think it's like a symptom of dependency which is overboarding, and I think that dependency also shows up in regulatory contexts. So for example, Daniela Gabor talks about the way Euro-dollar stablecoins are regulated right now with the comparison of the MiCA regulation and the US Genius Act, where you have like a regulatory, where she says there's a regulatory arbitrage, that it's more profitable for stablecoin investors to run on stablecoins in Europe, but to hold them in the US because it's more profitable there, which is just not a good thing for Europe. And also the implementation of Euro-dollar stablecoins through the partnership, for example, of Circle and Deutsche Börse, very much reinforces this dependency of Europe on the US dollar in the form of Euro-dollar stablecoins. So I'm wondering, in regulatory spaces, like how are you thinking about that right now? How are you considering that in like your proposals maybe for changing a regulation, and how prevalent do you see that necessity of getting rid of EU independence on US? Thank you.
Maybe I answer one by one so that the question is fresh in my mind.
David is not here, but okay, yeah.
Again, my personal opinion, and not the ESMA one. on MiCA, I cannot tell you much because it's not my area of expertise. It's true, ESMA covers ESMA, EBA, and EIOPA. They are the entities they cover MiCA, which, by the way, at some point will be probably be amended. So to consider. What I'm telling you, I fully agree on the assessment, the political assessment. The last few weeks has been crazy. Someone said in 1 week happens what happens in centuries. And I think that 2026, the first few weeks was precisely towards that direction. To be more independent is not only about, for instance, interest rates and the dollar, but it's also talking about infrastructure from payment systems, and from there is clearly a strong dependence on the IT side of things. Now the ECB is discussing about digital euro, for instance, which if it is under discussion, but if you remove from the payment system, and is this highly US led, you would have not for gigantic sums of money, but you would remove from, because I don't recall now how much would be the amount of money that is transferable through the digital euro and the digital wallet. I think it's below 1,000. It's something really. It's something very, very small, but you are removing U.S. and American infrastructure from the equation, and this may be something that you can leverage at some point to remove this limit on the payment system of the digital euro, and being even more independent from the U.S. payment systems. But this is something that I think we will see in the coming months, coming weeks. Not sure. Apologies if I cannot reply to everything you ask.
Hello, thank you. My name is Martina. I'm from Argentina, and I was wondering about a specific regulation of, you call it trading venues, like for cryptocurrency. Mm-hmm. Thinking about like the big scandal on FTX that kind of declared bankruptcy in 2022. That was like a big deal in Argentina because a lot of citizens have their savings in cryptocurrency. What are the specific regulations you are thinking about in the EU context to kind of avoid this kind of a thing? I just read that it was like in total like $2 billion worth of assets lost in that bankruptcy. So what are your propositions on this issue?
If you want to, all good.
The regulation there is MiCA, the MiCA Marketing Crypto Asset Regulation, also called MiCA, which I had a slide before with KESSE, Crypto Asset Service Providers. These entities would fall, they fall under MiCA. In this case, probably, again, my personal opinion, these entities are located in one jurisdiction. They are authorized in one jurisdiction. And to have these firms operating in their jurisdiction, perhaps the oversight is not done in the correct way. And we come back to the topic before, that if you have an independent regulator, is more prone to protect national champions which are based in your jurisdiction. So in this case, FTX was Sam Bankman-Fried in 20, that at this point in the US I think is in jail for quite a while now. at least that. But mm-hmm. Yeah, I cannot reply on this technically because I do not work, again, sorry, but I do not work on MiCA. I would check, but I'm sure that there should be some regulatory provisions under MiCA. But that is the two main legislation at EU level are MiCA, and another one is the pilot that was mentioned before, which I would say at this point perhaps is not the most relevant one. Is the DLT pilot, the distributed ledger technology pilot. But for your question, the legal reference is the MiCA regulation.
Hi, I'm Thiago from Brazil. And less of an economic question, but you were talking about headcount and some managerial structure of ESMA. And I was thinking, supervising this institution, supervising these markets in EU, and understanding how it's more effective. And I was thinking, how do you measure that? Because what kind of metrics do you use, these kind of things, to understand if you're actually being more effective and doing your part? That's it.
Do you want to gather more questions, or I think we had from Verity and then from Elu first.
I just had two kind of like more general questions. Like right at the start, you kind of discussed like cooperation with other EU agencies, but I was also wondering if you cooperate with other like financial regulation agencies like outside of Europe, and like how much the like European regulation influences like other countries' regulation. And then the second question I had was also just like very general. Like you briefly mentioned kind of like supervision, but I was wondering like if you could explain a little bit like the enforcement mechanisms that you hold as well.
Yeah.
Thanks.
Last one?
Yeah, sure.
I don't know if I'm Elu from Austria, and I don't know if my question is going in a similar direction, but what I was asking myself while you were holding your presentation is, what happens if any of the supervised entities or institutions do not follow the rules and regulations set by ESMA, and what would be the concrete consequences ESMA could enforce? Yeah.
I go backward. In your case, one tool that we have is the union of the breach of the union law. If there is cases in which the national supervisor did not perform his activities at the national level, ESMA can be contacted, and then there will be a decision for a breach of union law, where there is an investigation against the NCAs that did not intervene. They did not did his job. In terms of actual enforcement action, is very limited. It's simply, I think, a report that is published, but there is no, if your question is there a financial sanction against the NCA, the answer is no. Other authorities, yes. So in general, we cooperate mainly with the national competent authorities at EU level. Then, since they have, there is an agreement with Norway, Liechtenstein, and Iceland, also with these three jurisdictions. Since we had a very long relationship with the UK, because before Brexit they were part of ESMA as well. They had a member represented in the board of supervisors. The UK were an active member of the NCAs, but we still maintain a good relationship with them. At global level, you could see that there is, I paraphrase here, a global ESMA, which is called IOSCO, is based in Madrid, and is at G20 level, where you put at the same table all the G20 financial markets regulators, ESMA included, all the 27, not all the 27, all the EU countries that are part of the G20, plus the US, Canada, Australia, etc. So there is a way to coordinate at global level how to regulate financial markets. And is there where the EU can help in reshaping or shaping the EU financial framework at global level. That is the forum where you sit and you try to influence how to make and how to regulate financial markets. I think I have another question. Your question is about how we supervise. We have famous KPIs, but in general, what we do, and it will be more important, especially now, if this proposal, depending on how the proposal goes, we will have more entities to supervise. But the resources remain limited. Maybe you will hire some other supervisors, but if you have 100 firms coming under your supervision and you have extra 5 people, it will be, you need to understand that the resources are limited. We apply, and is a concept that is done at central banking level and among other supervisors, where it's called risk-based supervision. You try to measure at least every year, based on the portfolio of entities that you have under your supervision. First, you have a matrix, and you try to understand, okay, IT supervision, governance and conduct, business strategy. You try to develop a matrix with all these possible risks that can occur at the different firms that you have under your supervision, and you try to give some marks, trying to understand where are the possible risks at each individual firm. You try also to understand and to give proportionality. If the firm is only local, perhaps you will spend less time on it, but perhaps you will spend much more time in something that is more contagious because I have a more global footprint. And based on that, you have your risk assessment, and at least on a yearly basis, you know where to look into it. And that is the first part. It is the preparatory work for the coming year. So you do your risk assessment, you print it. From time to time, you look at it and you say, okay, this is what are my supervisory priorities for the next one, usually a couple of years. After that, you have your objectives for the year, and you simply say, did I manage to make sure that the IT infrastructure of this firm is working fine? Yes, no, partially. And you do it with all the firms that are under your supervision. At the end of the year, you have some KPIs that tells you, okay, in this area, we managed to obtain the outcome that we wanted. The risk remain low. We are happy about it. But it can be the opposite, and you can see that a risk that you did not foresee occurred, and then you need to readjust probably quickly based on the risk that emerge on a new risk and try to intervene with the firm. But in general, you have a risk assessment, the supervisory priorities, and then KPIs to measure that whether or not your supervisory priorities has been, you met them or not. And
If the questions are kind of short, I think we might have time for maybe even one more.
Thank you. Hi, I'm Nicolau from Spain, and I wanted to, I mean, it's not really related, but as you work like in a European institution, and I wanted to know like how like the opinion in these institutions usually is framed. For example, like I don't know, because I mean you're much younger than like 2008 crisis, right? So
2008 crisis was the reason why I did economics.
yeah, okay, yeah. I mean, it's, yeah. So, I mean, my question was like, how, like, usually, like, this crisis would be framed in this kind of institutions? Because, like, who gets the blame for? Because, for example, for Spain, I mean, for me, I will blame the European Union and how the European market worked in accumulation, and how, like, there was, like, huge investments in Spain, and this created, like, a huge disequilibrium in markets. But from the European side, it's probably the opposite, because you see Greece and you see like how austerity and how like they just like destroy that country, right? So how, like, who takes the blame if something happens? Is like individualized blame because you didn't obey the market, or I mean, I don't know if you, I mean, yeah, that's my question. So do you need a bit more?
I'm trying to understand the blame part of the what do you mean? What do you mean with blame?
Like the responsibility, like who has to pay for it? Because in Spain we paid for the crisis, but I mean, I will say it was not 100% on us, right? So yeah, that's the thing.
No other, there was another question.
I even asked him.
Hi, Theo from Germany. I would like to know what, from your perspective, what would be the main constraint or main difficulties in implementing capital controls, or consequences also of it.
Hi, I'm Jonas from Switzerland. I have a way more general question that goes kind of beyond this talk, but like I think I heard like some weeks ago that like the SEC under Trump, there's like the danger because like the SEC as a context, like they publish a lot of data, a lot more than in Europe and so on, and there's kind of the danger that this kind of no longer happens or not continues. And like admittedly, like when I worked for NGOs or like also in research and so on, it was always really nice to have all this SEC data. So I was wondering like if there is any effort internally also like to publish more data on like European companies and so on, in terms of like how much like stocks are owned by different companies and so on. Yeah.
Thank you. I will go first with yours. There is a project at ESMA which is European Single Access Point. And at this point, for instance, if you would like to see the financial statements for each firm that are listed, that they have product listed in the EU, you need to go to all different sources across the 27 members state in the EU. The project here that is led by ESMA is to have one single database, all in the same format, so that you can have access to this data easily, in a standardized way, machine readable, and you would have all the information, most importantly, comparable, because they are in the same data source and in the same schema. At this point, there is quite a bit of divergence if you want to have access to this type of information. Then another project on which I'm working is a so-called consolidated tape provider. Is a market infrastructure that is connected to the stock exchanges, and once there is an execution of a trade, price, timing, volumes, etc., they are published on the consolidated tape, and you can have access to it. there will be one for shares and ETFs, there will be one for bonds, and there will be one for derivatives. And this is one of the objectives of ESMA, is to maintain market transparency. With these projects, you will have full disclosure, at least on the firms that are listed on financial markets, but also on the products itself. You will have, for example, you will be able, since the financial product maybe is multi-listed, in one venue is with one price, and with another venue is in another price. You can have a check on that. The blame. For me, it's a difficult question. Who takes the blame? It depends on the case. In Europe, you took, for instance, the case of Greece or Spain, but ultimately, in the case of Spain, in Greece, you can see that the pain was on the member state, and rather than at European or market level. I cannot comment much on it. It's really how the market develop there. I do not have much information on the Spanish crisis and the impact on that had on citizens there. And unfortunately, on the capital requirements, I think on that the best people suited for that question would be mainly people from EBA, that they draft legislation on capital requirements and basically transposing the different Basel's requirements into the EU legislation. Finally, you tried, I think, 4 times.
Yeah, finally. Yeah, I had to sideline one topic in the presentation because we just have 5 minutes per person, and that is the question of blockchain technologies in reporting, but in trading, like the DLTs you also mentioned, the digital ledger technologies. I worked in the cum-ex control, like in the parliament in Hamburg before, and there sometimes we also had this suggestion, okay, if we don't have this reporting in book entries but something like blockchaining, we could have avoided falling for this scheme. And as cum is still a problem in Europe and there's still money made out of this, most likely, do you think by digital ledger technologies and other blockchains we can avoid stuff like this, or like tax evasion schemes that are made with arbitrage approaches? And yeah, if like, is this DLT program, like, what is the size of it? Is it actually becoming big enough to become more than just a pilot? Can you imagine to this becoming like a mandatory clause, because it would improve supervision by a lot probably, but it's also a lot of technology infrastructure and also technology implementation that needs to be done to have this in the full scale level.
I'll try to answer on this. I think from my previous experience short on the DLT pilot, it was and it is still a pilot. It's very limited and it was created in a sandbox environment. Ultimately, for trading venues, the legislation is MiFIR, and for settlement is the CSD regulation. And what we did, what ESMA did with the NCAs was we incentivize firms to enter in the DLT, in the blockchain environment, by reducing some requirements in MiFIR and CSD, so that you can come, test, and see if there is scalability, and you can make a profit and survive with this technology. At the beginning, I think the first few years, not many firms show up, but I will need to check. But I think definitely now you have market infrastructures that said yes to the project, to the sandbox, and now they are operating on the DLT pilot, both as a trading or CSD. In terms of the usefulness of the technology, I can agree with you. The issue now is to see how the SIU proposal on the DLT pilot make sure that it's not anymore a pilot. Make sure that is the DLT regulation and they are able to scale up because since it's a sandbox, there are some limits on the volumes, on the type of instruments that you can trade. The discussion now would be to assess whether or not, probably the answer is yes, to remove it, to make sure that you are not only a small innovator. From there you can try to grow. You had another point, I think.
If this is suitable to avoid arbitrage schemes like cum-ex and cum-cum. Especially since cum-cum is still like a problem, or most likely a problem in Europe, and only cum-ex is to be ruled out.
I'm not. Yeah, indeed.
Okay, yeah,
because I'm not.
I can try.
Please.
Okay. Cum-ex is an arbitrage, a stock arbitrage system. That was possible if you had stocks that were also exchanged in Germany. And the idea is that one company or one bank has a stock, and that stock is then not bought by a different bank, but just lended to it. And then both banks report the stock on their tax reports and get a notification that they had paid taxes for the stock. But only one bank actually owns it, so one of these banks gets back taxes that they never had to pay. And in this system, many banks participated and used chains or circles of lending stocks over the day where the dividend comes in. And this gave the ability to get taxes from the state that you never paid, and it costed the state, like, I think in 1 year around, we have banks, like one of the private banks in Hamburg I worked on, they had an arbitrage of around, or an acclaimed arbitrage of around 300 million euros that they got back from the state in money they never paid. So this is not just tax evasion, but getting directly taxpayers' money from the state to the bank. And a cum-cum system is something that's done internationally and is a bit different. Cum-ex is now illegal and ruled out in Germany, but cum-cum is still a problem in Europe. And the problem is, like, if you have trading and you have a lot of exchange and you have a lot of processes around the market, it's very hard for an agency like the BaFin, for example, to control for this, because we are talking about insane numbers of trades here. And blockchain would be a possibility to have something that is trackable in contrast to the book entry approach we have nowadays. And my question would be, like, what you think about this, and especially, like, can we actually implement this? Because, like, cum-cum is claimed to be, like, still a tax damage of around $30 million per year.
Not comment much.
But it's all acclaimed, like, I'm just talking about what I read in the news here.
No, I cannot comment much on this because it's a case I didn't know. Yeah. Thank you. The objective here is that if it's possible to leverage, to scale up on the use of the technology, I think there is a margin to use it. And the proposal is going towards this direction. I think that if it's possible, it will be implemented. No, indeed, I think I answered. I cannot give you much on that because I do not follow capital requirements. This is something that is mainly done at EU level by the European Banking Authority rather than ESMA. It's something that remains in the remit of banking regulation rather than market infrastructures and markets in general.
Once again, I'm not sure whether you can answer because you said you're not exactly this thing with MICA also, but I don't think it's covered by MICA. So, Shani from Sri Lanka. I've been studying a little bit about the US companies like MicroStrategy, where they're using like preferred stocks, etc., to raise capital and to buy Bitcoin as their treasury management assets. And like Capital B from France, they have also started that. Although they started off like being an AI company, data intelligence, all of that, they have moved towards this financialization way of doing things, and they are raising like capital, about 11 billion, issuing like preferred stocks, convertible bonds, all of that. So in terms of ESMA regulation, has there been any discussion on bringing in more regulation towards these companies from an EU level? Yeah, something along with that.
In this specific case, not that I'm aware, but I think, again, the legislation would be MiCA. It's what we showed before, the CASP, the Crypto Asset Service Providers. It's very long, the list. I think is something like 12 type of activities that the CASP can perform, and it would fall definitely in that area. But on this specific case, not that I'm aware.
I guess on behalf of every student in the report, thank you so much.
Thank you. Thank you.